Lululemon just released its Q to 2025 earnings report. And it's a mixed bag, some solid fundamentals, but also some cracks in the U.S. growth story. Our job as investors is to analyze the latest earning report and determine if anything has changed fundamentally about the business, so we can make better investing decisions. So in this video, we'll dive into Lululemon's earnings report, break down the 6 key metrics that tell the real story, and help us figure out if Lululemon is still worth your money. Welcome to Changhua Investments, where we break down everything that matters. Stocks that actually move the needle, leveraged ETFs that aren't just hype, and portfolio tactics that build wealth, while others are busy guessing. Let's get started. 1. Revenue growth. Starting off with revenue growth, which has been a bit of a mixed bag. In the second quarter, Lululemon reported total revenue of $2.53 billion, an increase of 7% year over year. On a 2-year stack basis, revenue has grown by 18%. But looking at the segments, we see that the Americas region grew only 1%, while international grew 22%. Comparable sales were negative 4% in the Americas, while they were up 15% internationally. Looking at the earnings call transcript, management highlights that the weakness in the Americas was driven by product execution issues in the first half of the year. The company says it didn't have enough supply of best-selling products like joggers and other bottoms. And they also had too much supply of certain items that didn't sell well. This resulted in lost sales of around $20 million. There was also a shift in consumer spending towards services, which hurt apparel retailers like Lulu. So for now, it seems that the slowdown in U.S. growth is largely due to operational and category-specific challenges, rather than a macroeconomic issue. The stock is down 47% year-to-date, and most of that decline has come since earnings. So clearly investors are starting to price in a period of slower growth. If the company can execute better and start delivering more consistent results, then there could be upside to these estimates. For now, though, we'll keep an eye on how the rest of the year unfolds. Number 2, profit margin. Moving on to profit margin, which tells us how much of every dollar in sales falls to the bottom line as profit. It's important to look at both gross margin and operating margin. Gross margin is what the company makes on each sale after accounting for direct costs. Operating margin is what's left after all expenses are taken into account. During the quarter, Lululemon reported a gross margin of 58.5%, down 110 basis points year over year. The company cited tariffs as the primary headwind impacting gross margin. Higher tariffs mean higher input costs, which in turn squeeze margins. To combat this, Lulu has been increasing prices across the board. But consumers have been responding poorly to the price hikes, which has led to clearance rates becoming even more aggressive. These promotions have put downward pressure on margins. Operating margin came in at 20.7%, down 210 basis points year over year. The company incurred higher operating expenses including marketing, technology, and selling costs, all of which weighed on the bottom line. Despite the margin pressures, Lulu still boasts some of the best margins in the retail industry, especially when it comes to operating margin. However, if these trends continue, we could see further declines in profitability, which would weigh on the company's bottom line. Number 3, earnings per share growth. Now let's talk about earnings per share growth, which tells us how fast the company is growing its profits. On a per share basis, it's a useful metric because it takes into account any changes in outstanding shares from stock buybacks or new share issuances. In the second quarter, Lululemon reported earnings per share of $3.10, slightly lower than last year's $3.15. Even so, it beat analyst estimates of $2.88 by 7.6%. This is a positive sign as it shows that the company is still able to exceed expectations despite the challenges it's facing. For the full year, Lululemon lowered its guidance range from $14.45 to $12.77 to $12.97, which represents a year-over-year decline of 11.2% at the midpoint. This downward revision could be due to the same factors that contributed to the Q to miss, including inventory issues and weak consumer demand. A big reason why the stock has crashed so hard this year is because of this lowered guidance, which signals that the company is cautious about the rest of the year. Keep in mind that EPS growth includes one-time items and share repurchases, so it's not always reflective of a company's underlying performance. That's why it's important to look at other metrics like free cash flow growth, which we'll touch on later. Number 4, return on equity. Next up, we have return on equity, or ROE. It's a measure of how efficiently a company is using its capital to generate profits. A higher ROE indicates that the company is able to use its equity more effectively to generate returns, which is generally a good thing. In the second quarter, Lululemon reported an ROA of 42.49%. This is an incredibly high number and shows that the company is very efficient at turning its equity into profits. It's important to note that the retail industry typically has a lower ROE compared to other sectors due to factors such as low margins and high competition. So Lulu's exceptionally high ROE is a standout metric that suggests the company is doing something right. Number 5, debt to equity. Now let's move on to debt to equity, which measures the proportion of a company's capital that comes from debt versus equity. A lower debt-to-equity ratio generally indicates a stronger financial position, as it shows that the company has less debt obligations that it needs to meet. In the second quarter, Lululemon reported a debt-to-equity ratio of 0.40, which is a decrease from 0.51 in the previous year. This is a positive sign, as it shows that the company is maintaining a conservative leverage ratio and has a strong balance sheet. The company has been focusing on deleveraging in recent years, which is likely contributing to this improvement. Overall, this is another metric that paints a positive picture of the company's financial health. Number 6, PEG ratio. Last but not least, we have the PEG ratio, which is a valuation metric that compares a company's price-to-earnings ratio to its expected earnings growth rate. A PEG ratio of 1 or less is generally considered to be attractive, as it suggests that the stock is not overvalued relative to its growth prospects. In the case of Lululemon, the PEG ratio is currently 0.75, which is below 1. This suggests that the stock may be undervalued given its expected growth rate. However, it's important to note that market sentiment can sometimes cause short-term fluctuations in a stock's valuation, meaning that the current PEG ratio may not accurately reflect the company's true value. Now let's move on to our valuation analysis using two different models. Model 1, fair value using EPS Growth and PE Peter Lynch model. The first model we'll use is the Peter Lynch model, which is based on the idea that a company's stock price should grow at a rate that is similar to its earnings per share growth rate. To calculate the fair value using this model, we take the current EPS, multiply it by 1 plus the growth rate, and then multiply that result by the average price-to-earnings ratio for the company's industry. Using this method, we get the following fair value estimate for Lululemon. First, we need to find the TTM EPS, which is the earnings per share for the trailing 12 months. We can find this by adding up all the company's net income over the past 4 quarters and dividing by the number of outstanding shares. We then need to determine the capped growth rate. The rationale behind capping the growth rate is that a company's growth cannot be infinite. At some point, it will reach a saturation point due to market size constraints, competition, and other factors. Therefore, capping the growth rate ensures that the valuation does not become overly optimistic and unrealistic. A reasonable cap for the growth rate could be in the range of 20 to 25%. Let's use 25% for Lululemon. Finally, we need to get the average price-to-earnings ratio for the company's industry. We can find this by looking up the industry's average PE ratio on a financial website. According to Yahoo Finance, the average PE ratio for the apparel retail industry is 15.41. Now, we can plug these values into the Peter Lynch formula. Fair value equals 25 times 15.08, which equals 377.00. Therefore, the fair value of Lululemon using the Peter Lynch model is 377.00. This suggests that the stock is significantly undervalued as it's currently trading at 206. It's important to note that this is just one valuation model and should not be used as the sole basis for investment decisions. Model 2, fair value using discounted cash flow DCF. The second model we'll use is the discounted cash flow model, which is a valuation method that uses a company's future cash flows to determine its present value. The DCF model takes into account the time value of money, which means that it discounts future cash flows back to their present value, using a discount rate that reflects the riskiness of the investment. The DCF model can be done in 2 ways. One way is to use earnings to calculate the company's free cash flow and then discount those earnings to get the present value. Another approach is to forecast the company's future cash flows directly. The latter approach is typically more accurate, but it's also more complex and time-consuming. Let's go through both approaches step by step. Step 1. Calculate free cash flow. Start by calculating the company's free cash flow. Free cash flow is what's left over after a company pays for its operating expenses and capital expenditures. It's essentially the cash that's left over for distribution to shareholders. Free cash flow can be calculated using the following formula. Free cash flow equals operating cash flow. Capital expenditures. Operating cash flow can be found on the company's cash flow statement, while capital expenditures can be found on the company's income statement under the heading Property, Plant, and Equipment. Once we have the operating cash flow and capital expenditures, we can plug them into the formula to get the free cash flow. Step 2. Forecast future cash flows. Next, we need to forecast the company's future cash flows. This can be done by looking at the company's historical cash flow growth rates and using that as a basis for projecting future growth. For example, if the company's cash flow has grown by 15% per year in the past 3 years, we could use that as a growth rate for future projections. It's important to keep in mind that this is just a simple approach, and that more sophisticated models may produce different results. Step 3. Discount cash flows. Once we have the future cash flow projections, we need to discount them back to their present value. This can be done using a discount rate that reflects the riskiness of the investment. A higher risk investment will require a higher discount rate. The discounted cash flow can be calculated using the following formula. Present value equals future cash flow / 1 discount rate. Number of years. By plugging in the future cash flow, discount rate, and number of years, we can get the present value of that cash flow. Step 4. Calculate enterprise value. The next step is to calculate the enterprise value. Enterprise value is the value of the entire company, including its debt and other obligations. It can be calculated by summing up the present value of the future cash flows and adding the present value of the company's debt. Step 5. Determine fair value. Finally, we can determine the fair value of the company by subtracting the company, cash, and marketable securities from its enterprise value. This gives us the value of the company's equity. Using these steps and inputs, we get the following DCF fair value estimates for Lululemon. DCF fair value EPS based, 456.59 DCF fair value, FCF based, $384.39. Both of these estimates suggest that the stock is significantly undervalued as it's currently trading at 206. Final verdict, is it a good time to buy Lululemon? Now that we've analyzed the company's fundamentals and valuation, let's address the question of whether it's a good time to buy Lululemon. Overall, Lululemon's fundamentals are still strong, with high ROE, low debt, and global growth potential. The stock is down over 45% year-to-date and dropped another 12% after this report, mostly due to U.S. softness and lowered guidance. However, valuation models suggest it's deeply undervalued, making it an interesting opportunity for long-term investors. In the short term, we can expect some volatility as the market digests the latest earnings report and the company works through its challenges. But for those who can stomach the short-term noise, the current pullback could present a good entry point with significant upside potential. As Warren Buffett famously said, "Be fearful when others are greedy, and be greedy when others are fearful." Right now, it seems that fear has taken over the market sentiment for Lululemon, creating a potential buying opportunity for savvy investors. A dollar cost averaging or buying on dips strategy could be smart. But as always, do your research and make sure this company aligns with your investment goals and risk tolerance. Thanks for watching, and until next time, happy investing.